US government spending is they can't control themselves. I mean, they're like, kids in a candy store given free reign, just take whatever candy they want.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi, my name is Shane Moran, and I'll be your host for this week's episode of Live from the Vault. Welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him pull back the curtain, we will be joined by popular demand from you, the Live from the Vault community, from the one and only Dave Kranzler, industry expert over at Investment Research Dynamics. That's right. Dave Kranzler is in the vault, and you're not going to want to miss this conversation. Just before we introduce our special guest and head over to the UK, please help us spread the word about this channel by hitting that like button. Not now, but right now. Go ahead, hit the like button, share this information, and if you're not already subscribed, do so. If you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. Now, Dave Kranzler, for those that are new to the community, he is the founder of Investment Research Dynamics and the Mining Stock Journal, which is a bi-weekly report that focuses specifically on the junior mining stock and lots of ideas in there. And he's been focused in the sector for over 20 years. So be sure to visit Dave Kranzler there at investmentresearchdynamics.com. We'll put a link down below there. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Dave Kranzler. Over to you, Andy.
Well, again, this is fun time for me. We have our friend David Kranzler here, Dave, as we call him, Dave from Denver. Isn't that what we call you, Dave from Denver? So we know where you're from.
Bill Murphy originated that term, and it just kind of stuck for like the last 10 years.
Well, it's nice. It's so nice to have you back. And you know what? Every time you come on, I just everything starts popping in my head. Whoa, Dave, what's going on? And your side of the pond, especially. I mean, obviously, we're going to talk about gold and silver. We're going to talk about so many things. But hell, I mean, I was talking to, I think our last episode, we were talking to Bill Halter. And we're talking about the broken system, the debt relief. I mean, good God! I think we're talking about we're now talking about maybe $1 trillion just to literally finance the existing debt. What's going on, Dave? What's going on?
Bill, he may be the only one who's more bearish than I am on the world. I mean, it's the spending. The U.S. government spending is they can't control themselves. I mean, they're like, kids in a candy store given free reign, just take whatever candy they want. And to me, I mean, I'd like to see I'd love to know how much of that money is actually circulating back into the pockets of the deep state bureaucrats and congressmen. And well, we know a lot of it's circulated back to Biden and his son and his immediate family members. So, but I think the interest alone on the debt now is approaching $1 trillion a year. And they spend more on interest expense on the Treasury debt outstanding than they do on defense spending right now. And quite frankly, I mean, I believe in protecting our borders, but I think they really need to cut down the defense spending. That's a big part of it. And obviously entitlements too. So, but I mean, I think we've reached the stage where there was a chart of the outstanding amount of Treasury debt over like the last 40 years, and the chart's gone parabolic, and the chart for the cost of interest has gone parabolic, and I think we've reached that state where it's the U.S. government crossed the Rubicon on that many years ago, but I mean, there's no way out of that. There has to be some type of debt reset because it's a problem it's just going to keep getting worse and worse at a geometric rate, and there's just no way to fix it. Although I guess they could, if the U.S. truly has 8,100 tons of gold in its possession, which I think you and I both highly doubt. You could just back the currency with gold and reset the price of gold, right? Like they did that in, what was it, 1934, I think, the Gold Reserve Act under FDR. And that, that was I think it was a 75% reset in the price. So, I mean, you could monetize the debt doing that. And I'm sure the rest of the world would be happy to go along with that, because we know China and most of the Eastern Hemisphere governments own a ton of gold.
Yeah, and it's funny. This is something we're really focusing on. What is so interesting is that back in November of 2022 was the exact point that the Bank of International Settlements squared up over 500 tons of their swaps, derivatives, knowing it was the Bank of International Settlements that actually, after March 2020, and they saw the implosion, $100 bid-ask spreads, having to bail out the banks who were really stuck on this 100-to-1 ratio, and they thought, they could just continue it. And then suddenly you get a black swan event like COVID, just happened to freeze the bullion, and it exposed the 100-to-1 game. And the Bank of International Settlements, realizing that gold is such an important asset class, what they did was then it essentially made sure at that point there, that's when we saw Basel III regulations starting to be reproposed. We saw the LBMA, the CME fighting against it. No, we don't want this. We don't need this. Trust us, and of course, but against all their wishes, they said, no, we're imposing them on the 1st of January of 2023. And they were imposed. Now, what that did was suddenly morph gold into a first-year asset class. And so obviously, to be a first-year asset class, you need to ensure that the liquidity providers providing liquidity to the over-the-counter markets, which are outside of the COMEX, they have to have the physical. Otherwise, how could it be a first-year asset class if it's not physically backed? So I guess really it raises so many issues here, because that also meant that, hey, hang on a minute, if I'm an institutional or a central bank or a sovereign, I've got a lot of treasury debt here. Wow, all that printing going on, trillion to just to even finance the existing debt. Hey, there is another asset class here, first-tier asset class out here. And it actually competes with Treasury, but it's so much more valuable than a Treasury, because Treasuries have default risk. Everyone will tell you it's possible for a Treasury to default. We've seen multiple close shaves, but gold is the only asset class out there, the only asset class that has zero counterparty risk when it's physical. So naturally, we're seeing, this is so interesting, because for the first time in 50 years since the COMEX was formed, after Nixon took the convertibility of gold from dollars into gold, we've seen suddenly gold becoming, you've got central banks saying, hold on a minute, this is an asset class alongside treasuries. Why don't we diversify some of our treasury holdings? Obviously, you can't dump them all overnight. You shoot yourself in the foot. But why don't we diversify some out and buy physical gold? And this is why I think the Fed is the only central bank out there that is actually still playing this 100-to-1 game, because they're trying to support, they see gold competing with treasuries. And obviously, that's the 3-card Monty that they're playing there. So it's an interesting dynamic to me that this physical gold is now undermining what to us is a massive short position that the Fed holds alone, absolutely holds alone.
I mean, it gets even more interesting because, yeah, they're short gold in derivative form, but there's been plenty of work done that shows that they've leased out, maybe they have legal title to the gold that they hold on behalf of the Treasury, but most of it's been leased out. I mean, we saw that they don't hold much physical gold when Germany tried to repatriate. They wanted to repatriate originally, I think it was something like half of the 1,500 tons the Fed allegedly holds for them.
300 tons. Or they just wanted 300 tons.
Right. It was negotiated down to 300.
Yeah.
And I mean, a couple years earlier, we saw Hugo Chavez move 200 tons from around the world to Venezuela in like a month. And the U.S. said it needed several years in order to fulfill that requirement. And from the reports that we saw, a lot of the gold that was returned was not the original bars that were sent over to the U.S. after World War II. So, they're short quite a bit of physical gold also in the form of leased gold. And I mean, good luck trying to get that back without driving the price, to Pluto.
Yeah, that's so true. And I think it would behoove them, because every central bank around the world has a gold account, a gold revaluation account, essentially. And from time to, as you say, I think twice in history, the Fed's done it or Treasury's done it. But the thing is that to me, it would actually make sense for the Fed to do that, even though, because as you say, this gold, whether it physically is there or not, I don't know, because they wouldn't even allow the Bundesbank to go and inspect the vaults, let alone whether they were rehypothecated, which you wouldn't know. But essentially, assuming 8,133 tons is sitting there, and that it's been rehypothecated, been lent out dozens, and God knows how many times, swapped, it's derivatives surrounding it. Well, if you were to revalue it, no one would know. If you just did it on your revaluation account, stroke of a mouse, whoom, suddenly, oh no, not $42 an ounce. Let's just pick 1,900. Now, that's a hell of a lot. I mean, or you could even pick a price. Well, obviously, you pick 1,900, you pick 1,800, whatever. You want a price rise after that. You are now in the game. So, but the thing is, to me, if they did that, Dave, they could probably sneakily get away with the fact that no one would ever know that it was rehypothecated, because if every other central bank is revaluing gold and they don't, then it's just going to cause them to turn and do what the German central bank did. Excuse me, I think we want to revalue our own gold. We don't really want it at 42, but we want to bring it back. So to stop that happening, they might be forced to do that, because otherwise they'd be exposed as having, they'd have to go to the market and try and buy it all back. Well, what would be the price of gold then? 50 grand an ounce? I don't know. What would it be?
Who knows? I mean, after a few years into this, back, around 2002, 2003, and I had just immersed myself in everything I could get my hands on to learn about the market, including all the associated supposed conspiracy theories, and many of them are now conspiracy truths. But I have always thought that if the world does go back to a gold-backed reserve currency system, why wouldn't the central banks of each country require an independent audit of not just the vaults, but also the files and records of the gold, and be able to match serial numbers to bars and things like that? Because if I were XYZ central bank and I know I'm sitting on gold that I possess, it's not rehypothecated, I want to make sure that my counterparties are in the same position. Wouldn't you? Mm-hmm. That's why I've always kind of thought that if the U.S. were in a position like that where it was going to be exposed and the world was going to force the issue, how do you get out of it? You start a war.
Wow. I mean, yes, that is one of the, I think you've just named the elephant in the room here.
Yeah.
And what have we got? We got another black swan event here. When it's almost like in history, Dave. I mean, every time governments screw up, every time things get out of kilter, what usually happens?
Exactly. when all else fails, start a war.
Yeah, and I think the thing is, this time around, it's a different picture, because I think when Biden screwed up Afghanistan, when the US lost so much face, being literally run out of Afghanistan, leaving billions and billions of dollars worth of equipment there for their enemy, their failed attempt in Ukraine, which will never succeed, to literally to try and take control of that, of the resources of that area, to really take down force a regime change, which they'll never be able to do. No one's ever managed to do that. Everyone who's tried that with Russia has failed.
That's right.
And now you've got a situation where nobody fears them anymore. This is a bit worrying to me.
I mean, throw China into the mix, because we know China is an ally of Russia. And, that those two opposing forces, the U.S. and Russia and China silently, they're at loggerheads over in the Middle East right now, specifically in Syria, but that could get a lot worse quickly. I mean, it's one of these things that, I try not to be in denial of too much, but that's one of the things that I just don't like to think about, because I won't go to sleep at night wondering if I'm going to wake up the next day. And I don't know if you ever read the book The Road by Cormac McCarthy.
No, I didn't.
You should read it. You'll start reading it, and you can just get it. Amazon's probably got it for $7. I started reading it on a Friday, and I had to read it all weekend. And it's about what a post-nuclear apocalypse would look like, in the United States. And I mean, it's really well written, and it's not that long. And interestingly, he refused to take interviews about, because he doesn't really spell out for certain what happened, but you can tell by the description of the surrounding buildings and landscape that it was a nuclear disaster. But he refused to take interviews about, what his intent was, what his vision was. But I mean, it's pretty clear what his vision is. And so it's kind of like, when I think about that, it's just, that's why I don't like to think about what's going on too deeply, geopolitically, because we could be at that precipice right now.
Yeah, and I think, as you say, nobody knows what. As you say, nobody knows. It could really escalate. It's not. I mean, everyone who's ever tried to fight US dollar hegemony in the past have come to a very sticky end. But I think now, as you say, you've got the global South essentially getting together and looking, and China, Russia, pretty much behind that, and Russia now heading up the chairing the BRICS, the BRICS system next year, in 2024, and Glazier's already talking about, we need to have other currencies, denominated currencies, to trade our commodities, and why not? Let's introduce a 20 commodity currency that basically that is backed by gold, and all of these things make sense. And so if you're in the commodity business and you have the lion's share of commodities amongst these BRICS nations, what do they want the dollar for? I mean, why do you even want to convert into the dollar, which has already been weaponized several times over history? So it's interesting, because this is a change that we've never seen before, and so I think people fear China, people fear Russia, people fear the BRICS. No, basically, to me, all they're trying to do here, I don't think anyone's trying to take control of anything. What they were saying is, look, if we take down the barriers and we kind of get on, and none of us have to be in charge. It'll just be denominated by, who's got what and what we exchange with each other. And the US has nothing to do with that. So this is an interesting dynamic. But I think if gold is used and gold will be used, as far as I'm concerned, as clearly as the currency, the money it is, the currency it is, ultimately moving into to backing up the commodity trade, which is a multi-trillion dollar. The energy trade is a multi-trillion dollar trade, and ultimately the bulk of it then transacts in that sphere. Then what that's going to do is cause the price of gold to rise up. And if the Fed is fighting the gold price, which I don't think the West is anymore, then it would make sense to have a higher gold price, because otherwise, if you pay for stuff in dollars, it is going to be hugely inflationary.
Yeah. Just out of curiosity, what are you seeing that makes you think the West has stopped fighting the price of gold?
Oh, really? It's really to me, it's what the Bank of International Settlements are doing, and I think it railed against what the Fed's doing completely. They completely covered all their short bets. They know what's coming. They're well connected. Every first year bullion bank that we deal with is long physical gold, and really there's every central bank that we know of, and not just Russia, China, but every other central bank is accruing physical gold on the book, but mostly off the book, because monetary gold does not have to be disclosed. When you move monetary gold around, it's not reported anywhere. So it makes sense that every central bank knows what's coming. They know that that the fiat system is struggling, and so therefore, and to me, when you've got the central bank of central banks revaluing gold in the sense that they want to get rid of all their liabilities, when it was very profitable, they had 700 tons from time to time, 500 tons when they started 2022 trading, over 500 tons, and by the November, all of those, every ounce of that was covered. What to me, it tells me they don't want exposure to derivative gold.
Yeah, that's interesting, and I think you're probably onto something there, because also the U.S. doesn't have undue influence over the BIS the way it does over like the IMF and some of the World Bank, and I think it's because the People's Bank of China and the Bank of Russia are also members of the BIS. So, and clearly, as we've just discussed, the balance of power in the world has shifted into one in which you've got probably equal standing, if not more than equal standing, by the Russia-China axis. But I still think, just looking at the way gold trades over a given 24-hour period, and the way that the commitment of traders reports shifts around between, where the bullion banks are either really net short paper gold and silver, or as we've seen recently, they just got net long paper silver, and it looks like they may be on the way to balancing out their COMEX futures gold books, between the longs and the shorts. And if I recall, I should have looked at it before, this morning before we jumped on, but I think I saw that the managed money category in the commitment of traders report, which is basically hedge funds and CTAs, I think they're now a little bit net short gold, paper gold anyway.
Gross and net short. Absolutely.
Yes. And so the reason why I think at least the U.S. influenced and controlled banks may still be trying to fight the prices, if you just go back, from memory and just go back like 6 months, you still have a situation where 85 to 95% of the time, in a 24-hour period, the gold price rises during Eastern Hemisphere Asian market hours. And that's what I call the physical gold market. And then, boom, right as you go into the AM London fix, the price gets hit, or it gets hit right after the fix is settled. And then obviously, it bounces around. And then obviously 85, 95% of the time, it gets banged again when the COMEX gold floor opens at 8:20 East Coast time. And to me, that's the influence of the paper market. Now, I agree. I think part of that is the momentum trading that the hedge funds and the CTAs engage in. So I'm not saying it's 100% the banks, but I would suggest that they know the hedge funds and the CTAs are going to follow the momentum on a short-term basis, and I would suggest that they get the ball rolling in that regard.
Yeah, no, you're right, but I think they're also led by the nose to some degree, because to me the COMEX it's really structured like a casino where you've got the pit managers issuing chips out they're loaning chips to the speculators, and no one's ever going to take delivery. You know that.
Yeah.
So and you've got the book on them, and you go, oh, hang on, they borrowed that much, so if I take it below this level here, they'll have to fold, and so as you say. But I think what's interesting, I think the game as it shifts, and I think again at the 1st of January 2023, we saw as the spot gold market, which is 10 times larger, really became Basel III compliant. So if I'm a liquidity provider in the over-the-counter markets, I have to have the physical. Now the game is okay. I have to have the physical, but hey, I can still game the COMEX guys because there's a bunch of speculators there that'll never take delivery. So I have to now calculate how many shorts on the COMEX I can put up more than the physical I really own. So, but that's limited to how many speculators are willing to take them. And I think so. Then, as you say, then your COT report, then you see that ebbing and flowing, and so that game can be fairly fluid. But what's interesting to me is that because these guys who have the physical in the over-the-counter markets, they never want to deliver any of that physical. It's their physical. They don't want to deliver it. So when they try to read what these speculators are doing, and if the speculators have reached a certain limit, which as you just talked about, the COT report, it shows them going gross and net short. Well, time to ring the register, and so the game has gone on. But I think I think there's lesson each time they do that. To me, the stair step is just that bit higher, because they have to jump in before if they run out of specs to short cover into. You better short cover quickly. And I think that's what we saw in the last 3 COT reports. I know that this is going to be published a bit later in a couple of weeks from where we're recording this. But essentially, so what we saw is the swap dealers, the predatory guys, the swap dealers that we know, they're agent banks that we know very well. They're not necessarily trading their own book. They're trading the Fed's book. They're trading a management book. But when they started to cover before a price smash, like short covering and going long, net long before a price smash, it tells us, hang on a minute, they've reached an inflection point where more physical they're having to cover more shorts in the COMEX to protect their physical positions than they can lay off on the specs. And it's interesting because we saw that in 3 reports.
Yeah, you bring up a good point there, and it kind of, I'm just so used to thinking, the Fed wants to, keep a lid on the price of gold at all times as much as possible. But you're right. I mean, especially given the BIS development, and that I think that's added downside stability to the price, period, even in the derivatives market. But you're right. I mean, pushing around COMEX futures is extremely profitable for these banks. And I remember back in 2000, I think it was 2012, and I can't remember the specific quarter. I think it was the first or second quarter. And the banks, their balance sheets, they had write-downs, their earnings were terrible. I mean, it was a bloodbath. But I remember there was one quarter where JP Morgan booked like $1 billion of profits in its commodities unit. And that was from silver trading, from silver futures trading. So you're right. Regardless of what the motive is for the central banks, the banks are going to go where they smell money, easy money to be made. And certainly the COMEX is that way for them.
Yeah, and I think the only one thing that's brought some form of discipline to that trade is simply the balance, where because you have to have where you never used to have the balance, the physical. So in March 2020, there was $100 bid-ask spreads. Why? Because these guys didn't have the physical, that they had longs, the liquidity provider providing the longs to the spot market. And no one's expecting to ever force that to delivery. And if it is, it's going to be maybe 2 to 3 tons in a day maximum. And you know roughly what, and you're pretty much in control of that game. But then suddenly COVID hit. It was a black swan event. Okay. And yes, it's suddenly the physical stopped, but it did expose the 100-to-1 ratio.
Yeah.
And because then it was $100 to even buy back a single short on the, and it really exposed that 100-to-1 game. And I think, so since the 1st of January, you've certainly got the bullion banks. No longer are they absolutely naked. They're not naked short at all. They have to even play this game. The Bank of International Settlements forces them to have the physical in their account. It must be auditably in their account. That never used to be the case. But as you say, but you can game that against the speculators in the COMEX, because that's your legitimate short. So it's really the amount of leverage. So I think the game's changed, but obviously there's still very, very profitable game to be played against these idiots. I call them useful fools.
People they've asked me for many, many years, why do the hedge funds keep going, letting themselves go through this cycle? And the only thing I can think of is that when you're marketing your fund to an institution, a pension fund, you need to, you've got the Sharpe ratio, measures of risk and volatility that pension funds want to see before they'll invest. And adding gold, whether it's derivative form or real gold, and obviously it's always derivative form, that helps bring down, because gold's got a slightly negative beta to the stock market and the bond market. So I that's the only reason I can think of why these guys endeavor to in the casino of the COMEX, is so that they can, when they show their portfolio to people they're marketing their fund to, and say, hey, see, we've got our Sharpe ratio is lower than this guy's fund because we have gold in our portfolio. That's the only thing I can think of, because they take a beating every year on the COMEX.
Dave, you're 100% right. I think that is exactly exactly why. I don't think it's just naked long or short speculators. I think you're right. This is for a reason. It's done for a reason, but they still borrow it on margin.
Yeah.
And so which is the stupid part about it. But I think this is also another interesting factor, is that a lot of the CTAs in the States, basically all the US traders were forced in 2013. We had to get rid of all our clients. Everyone else all US clients had to now trade inside this COMEX bubble. You were no longer allowed to access the over-the-counter markets. That was done for a reason, and that was basically because they wanted to control a group of people that they knew they could always contain, and you can calculate what that is. And I think so. Yeah, the wash and rinse cycles continue, and they still continue. But on the 1st of January, when some of the CTAs, and I know of 2 CTAs in America, who said, right, I can't go and trade the spot market to offset my positions. Tell you what I'll do though. I see gold is actually a first-year asset class, technically as first-year asset class now. So therefore, I tell you what, I'm going to hedge a few treasuries against this position, but I'm also going to hedge a few gold positions, albeit GLD, albeit paper positions. I'll hedge these positions. But what's interesting is when they do that, they're not rinsable, because there's a proper reason for them to have that. They're actually valuing it as a first-year asset class against a risk position elsewhere. And so therefore, when you do the wash and rinse cycle, there's a few of these guys are sticky. They're just sticky. So I think that essentially reduces some of the open interest, the chips that are being divvied out to these speculators, who the useful fools that continue to play this game.
Yeah, that makes sense. And I wouldn't have been able to put that together, but you see quite a bit more than I do with your seat in London, so you're closer to those guys. But another thing that I've found that's interesting is that in the, if you just say, I don't know, I mean, the gold market, aside from, occasional rallies, the precious metal sector has been kind of in a downtrend since August 2020, right? But the downside has been limited. And right now, I mean, I think gold got as low as 1860 not too long ago, but 1900 seems to be pretty sticky. And with silver, 23 seems to be sticky. I mean, they're able to, because it's more volatile in the derivatives market, so they're able to push it around more. But I've noticed, at least for the last 9 to 12 months, every time they've banged silver below 23, and it's gotten even below 22, it snaps back really quickly. And we just saw it again recently between last week and this week.
Yeah, and I think you were one of the few people out there who I totally agree with on. You made an analogy about the gold market looking very, very similar to the structure that we witnessed in 2008.
Yes. I think yeah. And again, I mean, it's too symmetrical for my liking, because it's looking, back then we bottomed in late October and then shot up while the stock market continued to go south. I mean, here we are mid-October, and it looks like the latest downtrend, we may have bottomed and we're headed higher again. So, but it certainly, you got to layer onto that what's going on in the financial markets and in the credit markets. And it's also very similar. I mean, it's not, the crappy mortgages and all the derivatives associated with that we had in 2008, although I have my suspicions that that's in the mix, just under a different form, because it's much easier. A lot of the mortgages that are underwritten in the US, the 3% down payment, almost no debt to income ceiling, a lot of that stuff resembles the crap mortgages that were underwritten back, pre-great financial crisis. But now it's like, you've got a subprime crisis brewing in every sector of the credit market, including U.S. government debt. And so I think what's coming at us, or what's going to hit the financial markets, could be much more severe than what we saw in 2008. And by the same token, it's going to drive gold much higher, and silver.
Yeah, I absolutely. And I think one of the things that really got my attention was, think back March or April of this year, when you have regional bank crisis, huge issue there.
Yeah.
And then that spilled over, and it seems to have been contained. But when you look at that picture, and then you look at the Achilles heel of that is the commercial real estate market.
Oof.
What's your thoughts there?
Oh man, I think what we saw with the 3 regional banks going bust back in the spring, I think that was like tremors before a big earthquake. And I mean, everyone talks about what a disaster commercial real estate mortgages are, right? And a lot of them are trading below 50 cents on the dollar. And you hear about bankruptcies and foreclosures almost every week on buildings in certain cities. But one thing that doesn't get talked about is, to what extent are their derivatives connected with this credit default swaps and interest rate swaps connected with the underlying collateral, which would be the commercial real estate mortgages. And I haven't I mean, I don't have time, unfortunately, to pour through the big bank footnotes to their, I mean, I don't know if I'm sure you've tried to go through a big bank financial statement. I mean, it's like longer than the Old Testament. So it'd be like trying to find that information you're looking for would take quite some time. So, and piece it together and then tie it back to the balance sheet. So, I haven't bothered trying to do that. I've taken a dive into some of the regional bank balance sheets, and I still think that's the stocks are a short in that sector. But I just have a bad feeling that there's a big powder keg of derivatives that are connected to this commercial real estate debt. And that's really what sunk the system back in the great financial crisis. I mean, yeah, the debt defaults were a problem, but it was the associated derivatives that really turbocharged it.
Dave, do you have a short trading service? Do you not?
I do. I write and publish the Short Sellers Journal.
Yeah. So basically, I know that this is a subscriber only thing, and I'm going to ask you about the mining. I can't wait to ask you about some of the mining stocks, but I know that's a subscriber based service as well. But is there anything that you can share about, or even in general terms, about? Obviously, there are certain things that look like they're probably a good short. Anything that you wish to share on that?
Sure. So my number one and number two shorts, not necessarily in this order, are Tesla and Nvidia, and I'm not alone in that. I mean, it's anyone who knows how to do proper market analysis and financial statement analysis, it's an obvious short, both those stocks. And so on a weekly basis, I update information on those stocks and offer my thoughts. And, I'm always short to some degree, both stocks. But there's another one. And again, it's a lot of people are on this Airbnb, which is quasi commercial real estate, because a lot of Airbnb units are in multifamily buildings. But it's a great way to short the real estate, and it's just insanely overvalued. So, and I think Airbnb, I'm short it right now. It's trading at 122 and change. I mean, I think over the next 12 months, it'll at least get cut in half, 12 to 18 months. And it's hard to put time frames on this because there's still so much liquidity sloshing around the markets. That and with the hedge, we didn't have the hedge fund algos that we had to fight, 20, 30 years ago. I mean, the hedge funds they were quick draw McGraw and moving in and out of positions, but the HFT high speed algo driven systems, I mean, you can't compete with that. And so what happens is, that they'll pile into the short side. And then, everything gets oversold, someone starts buying and boom, it drives it right back up. But in general, these stocks are in a downtrend, and it's at some point, something's going to break. And we may have seen that with Nvidia just this week, and that was, the China regulations that the Biden government put on the chip sector and specifically on Nvidia, that was kind of sort of a semi-black swan, I guess. I guess it was lurking out there, but I don't think anyone expected it to hit, this week. And just in general, I think, so the home builder stocks, and I've been covering those for a long time. I traded home builder junk bonds back in the 90s. So I've been studying the sector for a long time. The home builder stocks, their valuations have completely dislocated from reality. The home builder, the sector itself has probably doubled in the last year. And it's just insane when you've got housing sales are heading south, both existing and new. And the only thing that's kind of kept their earnings above water is the price inflation in the sector. But that ship has sailed also. And there's, a couple different metrics you can use, but the home builders are more overvalued now than they were at the peak of the last housing bubble back in the 2007, 2008. And so I think there's a big opportunity there I'm sure Toll Brothers, and they produce, higher end new homes, average selling price 950 grand. And I've heard reports that, the high end is just starting to get slaughtered over here. And so I'm short Toll Brothers now too. And again, these home builder stocks are, it's something that I think they could lose 50 to 75% of their value over the next couple of years.
So Dave, you're talking about a minefield here. So I will say to people, look, if you're going to consider doing trades like that, get a professional like Dave. Let him, because things move so fast in that marketplace. You need a professional who understands who can assemble. Talk about HFTs, but you can assemble in your own mind with all that experience. You have an algorithm in your own mind that says, you know what, here's all the inputs and here's an output. And so I think people can't, that doesn't come free. And I think people who are interested in diversifying into maybe gaining a little alpha by doing things on the side like this, short selling, please make sure that you get in touch with Dave directly. This is why it's a subscription service. This is why you should be paying for this stuff, because if you're doing trades like that, you need to have good information, and at least the best information you can possibly get. So, but I really thank you for sharing that. But Dave, I was going to ask you, you're a mining guru, and I know you are, and we've talked about it in the past, and you have also have a subscription mining trading service. So, and again, it comes to mind because we're at an inflection point here. Everything from Basel III to the bullion flowing into the domain of the physical markets outside of the LBMA CME ring fence, more and more physical prices being set outside. This has got to affect the miners, because if anything, there must be leverage there that where you can leverage this expected rise in physical gold and silver prices.
Sure. There is that leverage there. And especially with the producing mining companies, the good ones that are well managed and that have a lot of reserves in the ground. But there's, the other variable you have to watch there besides the price is also the cost of mining, which has gone up, enormously over the last couple of years. I think it's kind of stabilized for now, but it takes 50% of the cost of getting the ore out of the ground and processed is energy. And so that can be problematic. However, there's every cycle you go through what's known as like a sweet spot. And that's where you get a massive run up in the price of gold and the costs haven't had a corresponding increase. So you get a window there where there's a big spread between the cost per ounce of getting it out of the ground and the cost and the price per ounce that the miners can sell it for. And I think, knock on wood, but assuming the trend that we're seeing right now continues, and I think there's a possibility we may be starting a sustainable rally. I mean, like something like we saw between late 2008 and late 2011. Mm-hmm. Don't hold me to it, and I hate to make price projections, but if we are entering that type of, call it a virtuous cycle, these miners are going to be, they're basically going to be the equivalent of central banks printing money, because the costs, at least for now, seem to have somewhat stabilized. And if you get the price taking off, there's going to be a window there and the well-run mining companies are making a lot of money now, a lot of free cash flow. Fortuna Silver comes to mind, and they're finally running on all cylinders right now. They have a brand new mine that just started up that, again, I think is probably one of the more profitable mines in the world right now, gold mines anyway. Mm-hmm. And they started generating a boatload of free cash flow. They're paying down debt, and they're going to reinvest some of that free cash flow into enhancing the resource base at their existing mines, plus develop a potential mine at an acquisition that they just made dirt cheap. I mean, that, a company like that does everything right. Most people are afraid to invest in the precious metals sector when it's getting hammered and it's unloved. But that's what they do that every step of the way. And then, so the producers, they're potentially central bank money printing presses over the next couple of years. But what I like to focus on, because I just find it, intellectually challenging, is the junior project development. Generically they're referred to as the juniors, but there's also producers that are considered juniors by market cap. But these are the companies that are out there developing a project, and the ones that I believe have viable projects. And of course, I think all the ones that I cover have viable projects. Some of them ultimately will end up not. But there's 3 or 4 right now that I think have very viable projects. And these things are trading as cheaply as they might have been back in 2001. And a couple of them, I think I've mentioned to you, Viva Gold. They've got, it's a small project. It's going to be a small mine, but it's open pit, low processing costs. They're probably, if all goes well, they should be pouring gold by mid 2025. And again, there's still some permitting risk and some mine construction financing risk, but they're largely de-risked, and it's got about a $13 million market cap. And if they get this mine up and running, based on comps, it should have $100 million market cap. But not only that, in the area where it's advancing its project, which is Tonopah, Nevada, in the Walker Lane trend, in that region, there's been, I believe, at least 3, maybe 4 recent M&A transactions of comparable projects that large cap miners like Anglo Gold Asante paid north of 100 million for, just for the project. And some of these aren't even as advanced as far as Viva Gold's project. So, and no one probably has heard about Viva Gold except, my subscribers and, the institutions that are invested in it, some other retail guys. But I like to look for companies that are not on the radar screen of most investors. There's another one that just released some news last week, and I'll be focusing on it in my new issue that comes out tomorrow afternoon. And I need to wait for my subscribers to read what I have to say about it first. I don't want to mention it, but
yeah, no, fair enough.
It's another one that, it's trading at what I believe are pennies on the dollar for what it's worth. Mm-hmm. It's got a near surface and at surface resource that it still needs to do one more economic study on it to see if it's viable, but I'm sure it's going to be viable. And they may be pouring gold by the end of next year. And we're talking, this is like the lowest cost gold to process, the near surface oxide ore gold. And, one thing that I like to see is when management invests in financings and has, a material equity stake in the company, and the CEO of this company participates in every single financing. And so, that's the kind of companies that I like to look for. And those are the ones where you really can get home runs. Now, you're going to lose money on some of them. So you keep a diversified portfolio of these junior micro caps. But if you pick the right ones, right now, I think these offer the potential for lifestyle changing profits.
Yeah, and generally as a group, they've been hammered lower, haven't they?
Oh, mercilessly.
Yeah.
Especially the juniors. We've seen a big rally in GDX and the Huey, the Amex Gold Bugs Index.
Yeah.
We've seen a big rally in the larger cap producers, to some extent in the mid cap producers. But these junior micro caps, Viva and the stock I just mentioned, they haven't budged in this rally. And part of it is, I think, because no one knows about them.
Wow. They will do if they get in touch with you. This is what, to be honest, I honestly believe that. there's a lot of free stuff out there, and that's great because it's about education. But I think when people start to think about employing trades, they really need to pay for it, because it doesn't come, you don't get that kind of stuff free. Because the minute for example, if you were on Bloomberg and you then said, here's this particular miner, I mean, it'd be blown in no time, because you'd suddenly see spikes, everyone coming in, shorting long, everything. But I think this is the kind of thing where you can, under the radar, you can find out what you've discerned, you've got a massive amount of history there. So you know kind of what to look for. You know all these, again, it's an algorithm. It's all these inputs. And some of it you just go, no, looks good on paper, but when you can come up with things like this, people should pay for that. And you know what? I mean, Dave, what do you charge for that service?
Not enough.
Yeah.
It's $20 a month. I can't tell you how many subscribers have emailed me and just said, hey, thanks, blah, blah, blah. You're really not charging enough for this, especially compared to other guys out. And it is what it is. I mean, it's, I don't know. I mean, I think it's probably, of course, I'm biased. I think my work is probably worth more than I'm charging for it. But part of it is I really enjoy it. And it forces, because I invest in just about every stock that I profile and recommend in the newsletter. And the other thing that I offer subscribers, I'd say a fair amount take me up on this, but it's like, email me with questions, or, have you seen a stock that looks interesting? Email it to me and I'll tell you what I think about it. And I'll also share my thoughts on that stock from, subscriber questions in the newsletter itself. So, in fact, there's one that'll be in there this week that a subscriber asked me about, and it happens to have silver in the name. And I said, look, this thing is, well, first of all, I think it's overvalued anyway, because the CEO gets a premium because of his name and his past track record. But I mean, this thing is in extremely early stages. It's going to take a long time to develop it. That said, because it has silver in the name, if we get a big rally in the silver market, it's going to be a rising tide floats all boats. But, the project that it has is probably at least 8 to 10 years away from, potentially being converted into a mine. And so I don't like to trap my money, if I can help it, into situations like that. So,
well, I think this is a great compliment to this mining service, is talking about precious metals. It's a great compliment to what you're holding, and when you're, in your investments in gold, in your investments in silver. And it's a great compliment to it. And perhaps giving you, as you say, that little bit of alpha, or gaining that bit of alpha. And I think that's a rare thing. And I think, how come, I'm going to ask, so how do people find you, Dave? Because this is important.
Oh, yeah. My blog is investmentresearchdynamics.com. And I don't blog as actively as I used to, because I spend a ton of time doing research and writing for the newsletters. So it's sometimes the posting, falls through the cracks. Posting blogs falls through the cracks. But there's links at the top of the blog where you can find out more information about the newsletters.
Well, we look forward to your Kinesis newsletters, and thank you for those, because they're valuable. And we had a ton of good feedback from our Kinesis clients about the input that you're creating there. It's a regular, I think every couple of weeks, isn't it, Dave? I'm pretty sure it's every couple of weeks.
3 a month, yeah.
Yeah. So and people should read those. I mean, and they're free. But as I say, I want to thank you, Dave. I can't believe it's an hour. I cannot believe it. But thank you so much for coming on and sharing some of this stuff with us. But we'll circle back again, and as soon as you're able, and see what see what people missed, see what people made, and hopefully people will come and visit you and ask those questions of you. And it's a rare commodity to find someone with that much knowledge, that much experience, who isn't charging $5,000 a month.
Oh, thanks, Andy. I appreciate it. And thanks for having me on. I love having these conversations with you because you're so much closer to the real physical market in gold and silver than I am. And I love hearing what you have to say about it.
Well, thanks, Dave. And as I say, get on his website, have a look, see what, have a look at the offerings there. And obviously, and thank you so much for all your Kinesis work that you do with us. Thanks, Dave.
Thank you, Andy.
Thank you, Andrew Maguire and David Kranzler, for another fascinating discussion. And remember, to our Live from the Vault community, buy physical, and make sure it's 1-to-1. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another episode of Live from the Vault. And again, remember to help us spread the word about this channel by hitting that like button, sharing this information, and be sure to subscribe if you haven't already done so. And if you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. And with that, we'll see you next time right here on Live from the Vault. See you then.